Hi everybody, this is Mr. Farmer. Welcome to AP Macroeconomics. Today we're finishing up our conversation on the Federal Reserve. We're going to talk about what the discount federal funds rate is and multiple expansion banking. Along with that, we're going to go over what the monetary multiplier is. We're going to talk about the concept of destruction of money, kind of from the financial point of view actually. And then we're going to do a quick rundown on all the monetary policies that we've kind of talked about in passing, but let's just take a moment and really solidify what they are. So first off, the federal funds rate and the discount rate. So we've talked about, the Federal Reserve would decrease interest rates. Well, what are they actually? So there's two that we kind of talked about. The federal funds rate is the interest paid to other commercial banks in order to borrow money. So again, if a bank doesn't actually meet the reserve requirement, what they'll do is they'll have to borrow some money is one option. They can borrow this money from one of two places. Another commercial bank, and the interest they pay on that loan is called the federal funds rate. If they borrow money, the commercial bank borrows money from the Federal Reserve Bank itself, that is a loan, usually a short-term loan, and the interest rate is referred to as the discount rate. Now you can see in the graph down below, the discount rate is usually a little bit higher than the federal funds rate, at least as far as 2007 to 2010. The Federal Reserve Bank is only in charge of the discount rate. That's when they can directly actually alter or change. However, they can target and impact the federal funds rate. One of the most obvious ways is if they decrease the discount rate, the federal funds rate usually follows. You can actually see the step down right here goes down, and you can see the staring effect, and you see a very slightly delayed impact on the federal funds rate as well. So they usually are kind of paralleling each other, with the federal funds being a little bit delayed on that. So multiple deposit expansion banking. So again, banks only lend out what they have in excess reserves, and we're going to assume they'll lend out 100% of that. So for instance, if the reserve ratio was 1/4 and checkable deposit of 1,000 was the excess reserves if there are $500 in reserves. Go ahead and take a moment, see how you do with that one. Well, the reserve requirement is going to be $250. Okay, $1,000, and they have to keep 25% of that on hand, $250. And then excess reserve, the amount of reserves they have, $500 minus the required reserves, leaves us with $250 in excess. So that's how much they would lend out. Let's go through some practice. Here's another one. So if the reserve requirement is 20%, how much is it going to be if they have a checkable deposit of $100 and reserves of $100? Then let's see how much they have in excess reserve. So they have to keep 20% of the checkable deposit on hand. So 100 times 0.2 means they need to keep $20 on hand. They have an actual reserves of 100. So actual reserves 100 minus my required reserves equals the excess reserve, which in this case is going to be $80. So because they're going to make a loan for $80, this $80 will become this checkable deposit for $80. We've seen that before. We've done that. But what happens next is what we're talking about now. What's going to happen is this money is going to be withdrawn. Somebody's going to take this money and use it. Now we're going to simplify this. So this is going to go over to, and they're going to spend all this money at some business. And this business is going to bank at bank 2. So all $80 is going to end up at bank 2, just to simplify this. So how does this look? So this $80 goes over here. This bank now has reserves of $80. This money is gone. $80 got taken out of the reserve, so this is now at $20. And then what can they do next? Well, now they need to keep 20% of this reserve requirement on hand. So 80 times 0.2, they need to keep $16 on hand. Actual reserves minus required reserves, $64. So we're going to create a loan of $64, and they'll have a checkable deposit equal to $64. So what happened? The original deposit was for $100. The bank then created a loan for $80. The next bank created a loan for $64. And like we talked about, That's money. It's usable. It was legal. It was accepted. It could be used as a medium of exchange. It has a standard of value. It was money. Both met the required reserves. They still had $20 for the first bank and $16 for the second bank, even after money was withdrawn. So how much new money was made just from these two transactions? $144 that did not previously exist was created. Money was lent into existence. Money is debt. We've said that phrase before. Now again, that was only new money. So here's an example of the multiple expansion banking. It's a nice one. So again, money goes in, they keep 10% in reserve, and 90% gets lent out. Then the next bank, Bank 2, they keep their 10%, they lend out the other 90%, and it keeps going. And this sounds like the GDP multiplier. It's because it really, really is. In fact, we have a thing called the monetary multiplier. Again, similar to the spending or GDP multiplier, instead it's for the banking. And just like the spending multiplier, we're going to assume it goes down to the fraction of a cent, and that is 100% borrowed and spent, even though that's not realistic. So again, this is the maximum amount of money that can be created through this system. So just like before, we have a multiplier. So in this instance, monetary multiplier is 1 over the required reserve. The required reserve, the symbol is typically a capital R, although RR, it can also be used, not a big deal. We do use the decimal form just to really clarify. So if you have 15% required reserve, you'll be dividing by 0.15 for the equation. So this is the maximum amount of money created. So maximum change in the deposit creation is I like to use the initial loan times the monetary multiplier. The reason why I like to use the initial loan is because that way it's easier to use, and you have to use one equation for the maximum change in checkable deposits. More about that in a second during our practice. So for example, if we have a reserve requirement of 100%, how much new money can be created? None. You have to keep it all on hand. How about if you have a 0.75 required reserve? Then it can only go so far. Well, if you have a 0.5, then it can double 1,000 up to 2,000. Well, if you have a 0.2, well, that would be a multiplier of 5, 1 over 0.2. So this $1,000 will eventually grow to $5,000. 1,000 of which was original money, so only $4,000 of new money was created. So back to the original bank, our reserve ratio was 1/5 or 20%. So initial creation was $80. That was the original lending. So how much new money is created? $400. And you can see this on the 13.2 McConnell-Brew 17th edition textbook as far as how it goes that much further. So one thing to note, this is the amount of new money created. If I want to learn about the total money supply, I would add in the original checkable deposit of $100 and get $500. So this is where you can get a couple different equations. If you do the checkable deposit times the required reserve, or the 1 over reserve requirement, that's going to be the total money supply. If I then subtract out the original checkable deposit, because this money already existed, I would get the change to the money supply, or the new money. If instead you plug into this equation, it's the monetary multiplier, R, times the original loan, that will get me the change to the money supply. If I then add in the checkable deposit, you come up with the 500. Now, why do I like this one? Because if this originated from a security, the initial loan is going to be for the entire value. We've talked about that in the 13.2 video. So that's why I like this, because no matter what, you can use the same equation for the change in money supply. So you can use either one, but you do need to keep track of, are you coming up with the change in money supply or the total money supply, and what question are you actually trying to answer? So just keep track of those, but those are the two different variations of the equation. So destruction of money. Just like with the consumption multiplier, it can work both ways. Now, money is made through lending practices, but what happens when that money gets paid off? If a loan is paid off, then that check or deposit is destroyed because there's nothing to back that money. That $80 loan now isn't worth anything, so it gets canceled out. That's how money is destroyed as far as the financial accounting measures are concerned. Therefore, the money supply is affected by the net outcome of loans created versus the amount of loans paid. So in any given day, if the value of loans created is larger than the amount of loans that were paid off, the money supply will be increased for that day. If instead the amount of loans paid off is larger than the amount of loans that were created that day, the money supply decreases for that day. So I want to do a quick rundown on buying and selling securities. So buying securities is going to be expansionary. And so you have the bank that has the security and the Federal Reserve that can print off cash. So if the commercial bank buys securities, okay, so the Fed, it's also from the perspective of the Fed, unless always stated. So if the Fed buys securities, that means the bank is giving them securities and the Federal Reserve gives them cash. Like we saw in 13.2, that's money that can be lent out. So buying securities or buying open market operations is an expansionary policy. Selling, from the Federal Reserve's perspective, means that the bank is using up their reserve requirement or their excess reserves in order to get access to the security. So selling securities is a contractionary policy. So here's the the 4 different kinds of monetary policies. I put them all as far as expansionary, so then the opposite would then be contractionary. So as far as open market operations, purchasing from the Federal Reserve's perspective is an expansionary. The reserve ratio, if you decrease the reserve ratio, that would be expansionary. If you change that discount rate, again, this is one that the Federal Reserve is actually in charge of, a decrease is going to be expansionary because it's cheaper to borrow money at that point. So a Federal Reserve is or a commercial bank is more likely to borrow money. And then they can target the federal funds rate, talk about how these two things kind of mirror each other. Again, similar to the discount rate, if you decrease, then that would be expansionary. And we don't tend to do this in our class, but the reality is, if the discount rate is cheaper, businesses or commercial banks are more likely to dip into the required reserves in order to lend out money. So again, we talk about the discount versus federal funds rate, multiple expansion banking, monetary policy or monetary multipliers, the destruction of money as far as accounting goes, and then monetary policies as far as what they all are. Until next time.